All right, looks like we're live. Welcome everybody to Live Valuation. I'm Midas Moriarty, and today we're going to be taking a look at ticker FNF, Fidelity National Financial, another company that we have covered multiple times on the show and is a personal holding of ours. Definitely looking forward to this one. As I mentioned at the end of last stream when I was talking about preparing for this stream, it is actually my largest position in my portfolio and has been for quite some time. I bought into this company in late 2019. Was keeping it a pretty small holding. I was just pretty interested in trying to get into, I was looking for interesting companies in various levels of insurance, and I found this company and thought it was pretty interesting and was bought a small position into it. And then we hit the pandemic and it crashed, and I had a lot of confidence in the valuation I had built for it, so I went pretty heavy on it as a result of that. And it's done really well for us ever since then, and has remained our largest position, even though we have trimmed it a little bit here and there. Just because of how much it's gone up. But I'm definitely curious to see where it stands today with the new 10K. And I put together a pretty decent model for how to project its revenues, which I think you guys will like, but I'll get into that once we get through all of the numbers. So Fidelity National, they kind of operate in three main segments. The main portion of their business is title insurance, real estate mortgage title insurance. So they're and other real estate services of sorts. But so they have a decent amount of exposure to the real estate market without actually having exposure to the value of the homes. They're a little bit more on the financing end of real estate. So it's one thing that I kind of like about them. But they also, in the last year and a half, made a very large acquisition of F&G, which is a pretty large proprietor of annuity and index annuity services and a variety of other financial services. So they added that onto their total segments, as well as they also have a decent amount of investment income, partially that comes off the back of essentially the float that they generate from both of those businesses. They have a really large investment portfolio that they manage as a result of having these two aspects of essentially manage insurance type products, because annuities in a lot of ways can be used like insurance like products, so obviously they can be used for a variety of other means. So they manage a pretty large portfolio, and that gives them investment income. So those three segments together, the title insurance, the mixed and various index annuities, as well as the investment income that they have, is basically the different types of revenue streams that we're going to project for them. So anyway, right here I have our little schedule of companies that we plan to cover. As I said, we're covering FNF today. I already have the stream for tomorrow planned. I'm planning to cover Nerdy Inc. I have that stream ready to go, all the prep ready and set up for tomorrow. And then on Monday, we have a few more companies of our list here that have put their 10Ks out, specifically Corsair and Turtle Beach, both of which are holdings of mine. Corsair is actually a pretty decently sized holding of mine as well, larger than Turtle Beach, though they're both pretty decent sized holdings. I think I'm going to be covering Corsair first, so you can expect Corsair to be the stream that we do on Monday. So anyway, getting into FNF, the prep work that I usually do ahead of the stream, I've already split off their segments to come up with an unlevered beta, which for, like I said, title, F&G, and investment income being the main segments they have, though they have this corporate other segment as well. Overall, I come with an unlevered beta of 1.13, which is pretty high, but they have pretty low leverage, and this industry typically has low leverage, so that's part of the reason. Sales capital ratio of 1.02, which is also pretty high, and a net margin of 10.46, which isn't super high, but with a sales capital ratio like that, that's overall pretty high. And generally, when these two are relatively high in combination, you also tend to see higher unlevered betas to basically up the expected return because of the high qualitative factors implied in the company. Either way, that's the segmentation that we sort of get for them, and I'm pretty sure they reflect well on both of those metrics. We will get into that once we do all their numbers. They're entirely US based. They're pretty geographically split across the entire nation as far as the real estate properties that they have their financing attached to. However, is just United States, so the equity risk premium is pretty simple for that. And as far as their book listed debt, they have $3.5 billion in debt, including their lease liabilities. And they have a weighted average maturity of 11 years and weighted average interest rate of 3.94%, which I am pretty satisfied with the changes that they've made over the course of the year. They've significantly improved their debt profile. Not that they have had a large amount of debt or anything. They basically have about the same amount of debt. They've added a little bit more debt than they had last year. However, last year they had a weighted average maturity of 5 years and interest rate of 4.1%. So they managed to more than double their weighted average maturity, which is pretty awesome. And they also managed to cut the interest rate at the same time. Not a huge cut, but considering they extended the profile, if they hadn't extended the date maturity, they probably would have been able to get a much lower interest rate. But typically, longer dated includes a higher yield. So the fact that they managed to get their yield down and their weighted average maturity way extended out is pretty awesome. So anyway, I will get into the numbers as normal. I have already done 1 year of their numbers as is. Pretty cool. See the P 5.61, super cheap in terms of that, but it is because of the fact that they're in an industry tied to the real estate, and so everybody's uncertainty about whether or not the transactions in the real estate market is going to continue and how that would impact their revenues moving forward. But we will get into that. Really good returns on invested capital and pretty good margins as well. So anyway, like I said, I will play the fourth quarter earnings call while I do the rest of the numbers. If you are watching at this point, please give us a like, subscribe to the channel, follow whichever platform you're on. You can also find all my other social media down in the description. We'd very much appreciate your support. Likes and subscribes is the only way we're asking for your support, and it's the only way we need. We're really hoping to grow this channel. So anyway, I'll play the call.
Good morning and welcome to FNF's fourth quarter and full year 2021 earnings call. During today's presentation, all parties will be in a listen-only mode. Following the presentation, the conference will be open for questions with instructions to follow at that time. As a reminder, this conference call is being recorded. I would now like to turn the call over to Lisa Foxworthy-Parker, SVP, Investor and External Relations. Please go ahead.
Great. Thanks, operator, and welcome again, everyone. Before we begin, and as a reminder, today's earnings call may include forward-looking statements and projections under the Private Securities Litigation Reform Act, which do not guarantee future events or performance. We do not undertake any duty to revise or update such statements to reflect new information, subsequent events, or changes in strategy. Please refer to our most recent quarterly and annual reports and other SEC filings for a discussion of the factors that could cause actual results to differ materially from those expressed or implied. We will be discussing certain non-GAAP measures on this call, which we believe are relevant in assessing the financial performance of the business, and you'll find reconciliations of these metrics within our earnings material available on the company's website. Yesterday, we issued a press release, which is also available on our website. Today's conference call will be available for webcast replay at www.fnf.com. It will also be available through telephone replay beginning at 1 p.m. Eastern today through March 3rd. Joining me this morning to discuss the business momentum we are seeing at FNF and F&G and our results in further detail are Mike Nolan, CEO, Tony Park, CFO, and Chris Blunt, F&G CEO. We look forward to addressing your questions following conclusion of our prepared remarks. And with that, I'll now turn the call over to Mike.
Thank you, Lisa, and good morning, everyone. I would like to start by thanking Bill and Randy for their leadership over almost 4 decades in building the industry's largest title organization and look forward to their continued support going forward. I also appreciate their and the board's support as I assume the role of CEO. I am incredibly proud of the business that we have built and am optimistic for the future of FNF as we continue to expand our industry-leading title business while growing F&G's assets under management. I would also like to thank our employees for their hard work and commitment over the last year. We could not have delivered such remarkable performance without their incredible effort. I'm pleased to announce strong results for the fourth quarter of 2021, building on the momentum we established in the first 3 quarters of the year. Tony will provide additional details on our financial performance shortly, but I would like to touch on a few highlights for the year. Our outstanding quarterly and full-year performance was driven by record results from our title business, as momentum in residential purchase and commercial revenue more than offset the ongoing contraction in refinance volumes, which have a significantly lower fee per file. On a consolidated basis, total revenue, excluding recognized gains and losses, was $4.6 billion for the fourth quarter, a 43% increase over fourth quarter 2020, and a record $15.3 billion for the full year, a 49% increase over full year 2020. This generated net earnings of $533 million in the quarter and $2.4 billion, or $8.44 per diluted share for the full year. Adjusted net earnings were $616 million in the quarter, a 5% increase over the fourth quarter 2020, and $2.3 billion for the full year, a 49% increase over full year 2020. F&G also contributed to this strong result. F&G sales growth remains impressive and above expectation as they continue to expand into new channels and grow their addressable market opportunity while continuing to have strong success in existing markets. For the quarter, F&G delivered total sales of $2.2 billion, representing a 50% increase over the fourth quarter of 2020. For the full year, total sales were $9.6 billion, double the prior year. Importantly, total assets under management were $36.5 billion at December 31st, 2021, which is well ahead of our goal of doubling assets under management over 5 years, as we outlined at the time of our acquisition. Total commercial revenue was a record $546 million, compared with the year-ago quarter of $322 million, driven by the 17% increase in closed orders and a 44% increase in total commercial fee per file. For the fourth quarter, total orders opened averaged 8,500 per day. For January, total orders opened were 8,700 per day, as we see solid demand and purchase activity while the refinance market continues to moderate as compared with last year's robust levels. Turning to order trends by type, daily purchase opened orders were up 2% in the quarter versus the prior year. For January, daily purchase opened orders were down 1% from last January. Refinance orders opened decreased by 44% on a daily basis versus the fourth quarter of 2020. For January, daily refinance orders opened were down 57% from the prior year. Lastly, total commercial orders opened per day increased by 13% over the fourth quarter of 2020. For January, total commercial opened orders per day were up 14% over January of 21. During 2021, commercial opened orders per day exceeded 1,000 from February through November, having consistently been in record territory, and decreased slightly to just over 900 per day in December before rebounding to over 1,000 per day in January. This provides ongoing momentum as we begin 2022, given the longer tail for closings in commercial as compared with residential. Our holding company cash balance was $1.5 billion at the end of the fourth quarter. This is unchanged from the sequential quarter, despite being active with our capital allocation strategy, which is focused on returning capital to our shareholders while making strategic investments in our business to drive profitable growth and attractive returns for all of our stakeholders. Over the last year, we have repurchased $461 million of shares and paid $446 million in common dividends, as we returned over $900 million of capital to our shareholders. Our adjusted earnings in the fourth quarter reflect the best quarter in the company's history, which speaks to our market-leading position combined with the outstanding performance of our entire team. For the quarter, we delivered record adjusted pre-tax title earnings of $717 million, a 15% increase over the prior year, and an adjusted pre-tax title margin of 22.4%. The results were driven by a 43% increase in average fee per file, a 17% increase in total commercial orders closed, and a 4% increase in daily purchase orders closed, partially offset by a 39% increase in daily refinance orders closed. Looking ahead, we expect refinance volumes to decline through 2022 as interest rates rise, given the outlook for inflation and the expectation for the Fed to tighten policy throughout the year. This is an ongoing trend, as direct residential refinance revenues have continued to be a smaller portion of our total direct revenue, contributing approximately 28% of total direct revenue in the fourth quarter of 2020, as compared with 16% in the fourth quarter of 2021. As a reminder, the refinance fee per file of approximately $1,100 is about a third of the purchase fee per file of approximately $3,400 in the fourth quarter, which provides a strong counterbalance to declines in refinance revenue. We will continue to evaluate market trends and manage margin by adjusting expenses to align with trends in opened and closed order volumes. Beyond our results, we continue to make progress on a number of fronts, including investing in technology to drive innovation, growth, and efficiency across our title operations. In addition to our ongoing investments in our market-leading title and closing solutions for independent title agents, as well as our real estate technology solutions for real estate agents and brokers, we are very pleased with the rollout of our In-Here Experience platform. At the end of 2021, 93% of our direct residential operations leveraged Start In Here for the first touch with consumers, and 50% of our eligible direct residential operations leverage the In-Here portal and mobile app with real estate agents. Given our industry-leading market share and profitability, we have the resources and expertise to make these critical investments designed to transform our customers' experience, grow market share, and improve profitability. Let me now turn the call over to Chris Blunt to review F&G's fourth quarter highlights.
Thanks, Mike. 2021 was a breakout year for F&G. We achieved record sales of $9.6 billion for the full year, double the prior year level, which boosted ending assets under management to $36.5 billion as of December 31st, as Mike highlighted. More importantly, we further expanded our distribution from one channel in 2019, independent agents, to now 5 established channels with the successful execution of our bank, broker-dealer, pension risk transfer, and funding agreement-backed note initiatives. Our fourth quarter retail sales totaled $1.4 billion, up 5% from the prior year quarter. Full year retail sales totaled $6.1 billion, up 43% from full year 2020. Core FIA sales of $1.1 billion were up 11% from the prior year quarter and in line with the record sequential quarter. We have seen ongoing success with our independent agent distribution, growing full year sales by 16% compared to 2020, and continued expansion of our bank and broker-dealer channels. With 5 new partners this quarter, we are now distributing through 17 banks and broker-dealers and have grown sales in that channel from $511 million in 2020 to $1.7 billion in 2021. Turning to institutional markets, our fourth quarter sales totaled $811 million, and our full year sales totaled $3.5 billion, comprised of $1.2 billion in pension risk transfer transactions and $2.3 billion in funding agreement issuances. We're excited about our launch into these markets and see a robust pipeline in 2022. F&G now has the flexibility to optimize growth across 5 distribution channels, and we will remain disciplined in our pricing and judicious in our deployment of capital. We're focused on generating scale benefits by increasing assets under management, while continuing to leverage Blackstone's unique investment management capabilities to deliver consistent spread. Building off last year's record result and with the previously announced capital contributions from FNF, we expect to continue to grow sales at a double-digit rate, outpacing the industry. This growth places us on a strong path to capital self-sufficiency. Next, turning to spread, our results continue to be strong. Total product net investment spread was 289 basis points in the fourth quarter, and FIA net investment spread was 359 basis points. Adjusting for favorable notable items, total product spread was 260 basis points, and FIA spread was 319 basis points, both in line with our historical trends and consistent with our disciplined approach to pricing. Let me wrap up with a few thoughts on earnings. F&G's adjusted net earnings for the fourth quarter were $90 million, reflecting an adjusted return on assets of 113 basis points and driven by record AAUM and strong spread results from disciplined pricing actions on both new business as well as our in-force book. Adjusted net earnings excluding notable items were $87 million in the fourth quarter, up $13 million or 18% from $74 million in the third quarter, and up $27 million or 45% from $60 million in the fourth quarter of 2020, primarily driven by asset growth. In summary, during 2021, we executed on our growth strategy, we diversified our sources of premium, and we're well ahead of the goal of doubling assets under management over 5 years as outlined at the time of our acquisition by FNF. Our record sales drove strong asset growth and generated solid profitability for the year. Looking ahead, we are well positioned for sustainable growth in sales and assets under management while consistently managing spread. With that, I'll now turn the call over to Tony Park to review FNF's fourth quarter financial highlights.
Thank you, Chris. Today I'll focus my comments on our earnings results, our performance trends across the title segment, and then I'll wrap up with where we stand on deployable capital and liquidity. Overall, results for the quarter were driven by title's record revenue and strong pre-tax title margin and F&G's sales boosting asset growth. We generated $4.8 billion in total revenue in the fourth quarter, with the title segment producing $3.1 billion, F&G producing $1.7 billion, and the corporate segment generating $42 million. Fourth quarter net earnings were $533 million, which includes net recognized gains of $213 million versus net recognized gains of $573 million in the fourth quarter of 2020. The net recognized gains in each period are primarily due to mark-to-market accounting treatment of equity and preferred stock securities, whether the securities were disposed of in the quarter or continue to be held in our investment portfolio. Excluding net recognized gains, our total revenue was $4.6 billion as compared with $3.2 billion in the fourth quarter of 2020. In the quarter, adjusted net earnings from continuing operations were $616 million, or $2.16 per diluted share. The title segment contributed $563 million, F&G contributed $90 million, and the corporate segment had an adjusted net loss of $37 million. For the full year 2021, we saw robust demand across the mortgage market, driving top-line performance as well as strong growth for F&G, which together generated strong profitability. Total revenue, excluding gains and losses, was a record $15.3 billion in full year 2021, despite the decline in refinance volumes, and reflects a 49% increase over full year 2020. This generated $2.3 billion in adjusted net earnings, an increase of 49% over $1.5 billion in full year 2020. Next, turning to Q4 highlights specific to the title segment, our title segment generated $3.2 billion in total revenue, excluding net recognized losses of $135 million in the fourth quarter, compared with $2.8 billion in the fourth quarter of 2020. Direct premiums increased by 21% versus the fourth quarter of 2020. Agency premiums grew by 23%, and escrow, title-related, and other fees increased by 3% versus the prior year. Personnel costs increased by 11%, and other operating expenses increased by 12%. All in, the title business generated a 22.4% adjusted pre-tax title margin for the quarter, roughly in line with the 22.7% in the prior year quarter. Importantly, adjusted pre-tax title margin increased to 21.7% for the full year, compared with 19.6% in full year 2020. Interest and investment income in the title and corporate segments was $26 million, and it declined by $6 million as compared with the prior year quarter due to decreases in bond interest and preferred stock dividends, as well as slightly lower 1031 exchange business income. Our title claims paid of $62 million were $45 million lower than our provision of $107 million for the quarter. The carried reserve for title claim losses is approximately $60 million, or 3.5% above the actuary's central estimate. We continue to provide for title claims at 4.5% of total title premiums. Our title and corporate investment portfolio totaled $6.7 billion at December 31st. Invested assets included $2.4 billion of fixed maturity and preferred securities, having an average duration of 2.8 years and an average rating of A2, as well as $1.1 billion of equity securities, $400 million of short-term and other investments, and $2.8 billion of cash. We ended the quarter with $1.5 billion in cash and short-term liquid investments at the holding company level, in line with the prior quarter, which was generated from title's organic growth and record net cash generation in 2021. Let me wrap up with a few thoughts on capital and liquidity. Our capital allocation strategy remains a key focus of the board, and our current level of cash generation supports a number of priorities. First, we are focused on making strategic investments to continue growth in the businesses. This encompasses continued capital investment in title technology and other strategic initiatives to support innovation and organic growth, committed near-term capital funding of $200 to $300 million as shared last quarter to support F&G's channel expansion and addressable market opportunity as they continue on a strong path to capital self-sufficiency, as well as strategically aligned M&A for real estate-related businesses, title agencies, and/or technology acquisitions, and maintaining an adequate capital buffer. Next, with regard to corporate debt outstanding, FNF's debt was $3.1 billion on December 31st for a 25% debt to total capital ratio, which is in line with our long-term target. This includes $400 million of 5.5% senior notes that will mature in September of 2022. Our annual interest expense on debt outstanding is approximately $100 million. And next, with regard to our common dividend, during 2021, we paid common dividends of $1.56 per share for a total of $446 million, reflecting a 16% growth in common dividends of $1.35 per share in 2020. We view our current $500 million annual dividend as sustainable. The dividend is reviewed quarterly and expected to increase over time, subject to cash flows, alternative uses of capital, and market conditions. And finally, our share repurchases. FNF continues to return excess cash to shareholders over time and has remained active throughout the fourth quarter and into the first quarter. During the fourth quarter, we repurchased 2.1 million shares for a total of $104 million and an average price of $50.70 per share. For the full year 2021, we repurchased 10.2 million shares for a total of $461 million at an average price of $45.22 per share. As Mike mentioned, we have returned over $900 million of capital to our shareholders through common dividends and share repurchases in 2021. To conclude, I would highlight that our businesses are hitting on all cylinders and we're coming into 2022 with good momentum. Our fundamental drivers are solid and we have a long history of preserving both title margin and annuity spread in different rate environments. We have balance sheet flexibility to continue strategic investments and return capital to shareholders. And we are well positioned to execute on our strategy and deliver results for shareholders and customers. Let me now turn the call back to our operator for questions.
At this time, we'll be conducting a question and answer session. If you would like to ask a question, please press star 1 on your telephone keypad. A confirmation tone will indicate your line is in the question queue. You may press star 2 if you would like to remove your question from the queue. For participants using speaker equipment, it may be necessary for you to pick up your handset before pressing the star keys. One moment while we poll for questions. Our first question comes from the line of Andrew Kligerman with Credit Suisse. You may proceed with your question.
Hey, good morning. Maybe the first question would just be, good morning, and maybe the first question would be around the F&G investment yield, ex the alts, of course. And at 4.83%, that's a pretty robust number. It jumped up from 4.66 in the last quarter, and then year over year 476. So I'm just kind of wondering, where that can go from here in terms of what Blackstone's doing. Do we have a floating rate element to it? Where can we expect that yield to go?
Yeah. Hey, Andrew, it's Chris. How you doing? I'd say a couple things. Clearly, it was boosted a bit during the quarter with some prepayments of some CLOs, and so that's a little bit of fronting of income. But I would say if you look at our prior quarter in that 350, 360, that feels like a very sustainable number for us based on what we see now. The origination of whole loans and other private opportunities remains pretty robust. There's a good pipeline of opportunities there. So I would say stable would be my best guess on outlook. Obviously, today's events, have affected spreads, and we'll see how long that volatility lasts. So that could create some marginal opportunities going forward. There's a little bit of floating rate impact in that, but 12% of our portfolio is in floating rate securities. A lot of the recent originations have a LIBOR floor. So that's kind of the best of all worlds. We're have a limited downside on rates and some potential upside.
Got it. Thanks, Chris. And then just with respect to that title margin, again, a very compelling 22.4. When does that go into your 15 to 20% range? I mean, it's starting to feel somewhat sustainable. Do you get to a point where you can change that guidance?
Well, Andrew, it's Mike. I don't think we're in a position to do that yet. Certainly a fantastic margin, and we've seen just really incredible margin expansion over the past few years. But we are still tied to transactional volumes, and as those change, that can certainly impact your margin. As we think about 22, we can't tell you what the margin is going to be, but we expect 22 to be very good. We've got a very strong commercial market, still good inventory coming in on that area, strong openings in January, a purchase market that is at least today still forecast to be stronger than it was in 21, which maybe was an all-time record year. And then you've got refis, which have come out, and I think as we look at the first quarter, that'll be one comp that'll be down just because we had tremendous refi revenue in that first quarter. As we go through the year, that may be less of an effect because those refis actually started coming out. Really as we went through 21, I think January of 21 was our highest openings for refis, and then they kind of slid down as the year went through.
And maybe I'll just add on to that. This is Tony. To Mike's point, refi was 33% of our direct revenue in the first quarter of last year, And as we've told you, it's gone down sequentially throughout the year. It went to 21% in the second quarter. It was 19% in the third quarter, and now 16% in the fourth quarter. So clearly that's coming down. And so, yeah, the first quarter of 22, we don't know exactly what it's going to look like yet, but refis will continue to trend down.
Got it. And maybe if I could just sneak one last one in.
Right.
I mean, what
These cash flows are a little bit complicated, and so is their balance sheets. It's taking me a little while to get through this. But one more year,
look at the stock,
and we'll do our 5-year trend.
Under 7 times our estimate for next year. Not only just on an absolute basis low, but low versus your peer group. And I mean, the execution couldn't be better. So, how do you want to react to that? Do you ramp up capital management? It was decent payout, dividends and repurchases at about 46% last year. Do you ramp that up? Do you do something with F&G? What are you thinking about this valuation and where you want to go from there from a capital management standpoint?
Yeah, thanks, Andrew. It's Tony. I'll start, and certainly the others can chime in. But yeah, it isn't lost on us that we're under 6 times or something like that, or around 6 times.
As I was just saying, like 5.5 times right now.
Probably worse, based on what's happening currently. We did return, over $900 million to shareholders last year that we mentioned in our earlier comments, including $500 million in dividends and about
it was like a 7.5% common yield, dividends and buybacks last year.
We are in the market. We were in the market in the fourth quarter with around $100 million in buybacks. But yeah, I could see, especially with continued weakness, I think it's a great buying opportunity. We're clearly disappointed in the share price and think that we should be buying back shares, and frankly, so should other people. We welcome all participants. But yeah, the board does look at this and talks about it a lot. And I don't want to give a number because I don't have a number to give, but I think $1 billion in return to shareholders in the coming year is probably a minimum, in combination with with the dividend, of course.
That would be like,
but we'll see. It could be more than that.
That would be like another 7.5.
F&G has been stellar, but you still feel good about that being a part of the company?
Yeah, we do. I mean, it's the growth has been fantastic. Clearly, we're not getting.
I don't know what that guy was suggesting. Are they supposed to sell it or something?
Know that we're building value there.
It's like, I'll get into it when I do my revenue projections, but I love F&G.
Right now,
I love it.
The capital
better not get rid of that.
F&G are fairly limited. We've talked about that. We loaned them $400 million last year, and we'll likely convert that $400 million loan to an equity contribution in 2022. And then we anticipate another $200 or $300 million of equity capital. That might be actually in 2023. So there aren't really immediate needs there. But yes, we love the performance, the growth, the asset growth, and the earnings contribution. And we expect that over time we'll see recognition of that in our share price, and if we don't, we'll have to figure something out.
Mm-hmm.
Thanks very much.
Our next question comes from the line of Mark DeVries with Barclays. You may proceed with your question.
Yeah, thank you. Just wanted to follow up on the capital return topic. Tony, how aggressive are you guys prepared to get in terms of buying back stock? Is there room to lever up to even accelerate kind of, what you've done, or even, have a management-led buyout of the company here?
Bro.
Yeah, it's a good question. I mean, there's first of all, we have ample cash on hand, as you know, at $1.5 billion, and expect strong cash flow generation in 2022. Based on our forecast at this point, We also have an $800 million line of credit that's undrawn, and we have a 25% debt to capital. We have earmarked $400 million of uses of cash to retire the bonds that mature in September. But is there room under our debt to cap? Clearly there is if we wanted to lever up. I can't speak for the board.
Very low leverage.
In terms of what we'd be willing to do. I don't know what a LBO would look like. It would clearly involve a lot of debt, which may be challenging as an insurance company, but there's creative ways to do a lot of different things. I hear your frustration. We share it in terms of the share price, and I suppose at some level, almost anything can happen for us to, if it gets too cheap, I guess I'd say. But I know I didn't specifically answer your question, other than I think we do have a lot of room.
Okay, no, that's helpful. And then thanks for the color on the order trends in commercial.
Honestly, that was a lot of candor.
Deal size, are you still? I mean, it seemed like some of the bigger transactions were a big part of the strength in the fourth quarter. How's that holding up? And how are you guys thinking about the impact of higher rates on the commercial business?
Yeah, sure, Mark. It's Mike. On the first question, clearly had a number of large deal size transactions in the fourth quarter. And you can just look at the average fee per file in national at 17.3. I think that's the highest it's ever been in any quarter in the history of the company. We also saw, though, interestingly enough, a continuation. It was something we showed up in the third quarter, but continued into the fourth with a really strong increase in local fee per file. It actually, the growth in local fee per file in the fourth quarter was a little stronger than the national, believe it or not. And we just continue to see this market that's so broadly dispersed geographically and also across asset classes. And to your last point around interest rates, I mean, it's a little tough to know how interest rates will impact it. I think there could be potential impact, I guess, as rates go up, but there still seems to be an awful lot of capital that is going into commercial activity, and maybe still some rebound effect just off of kind of the down year that we had in 2020. But to be at over 1,000 orders a day for, I guess now 11 of the last 13 months is just amazing to me.
It's just crazy.
Okay, great, thank you.
Our next question comes from the line of Boss George with KBW. You may proceed with your question.
Hey guys, good morning.
All right, so we're gonna pause there. I definitely feel like it's taking me forever to get through these numbers. Their balance sheet and their cash flow statement are both a pain in the ass. As I've complained with some other companies before in the past, they don't segment off their assets and liabilities into current and non-current assets and liabilities, so I'm kind of having to make some judicious decisions about which items I'm going to include in either of those categories. And then the cash flow statement is just super complicated because they have all the investment related activities, and usually for most companies I just bypass the investment activities, assuming that they just kind of cancel each other out over the long run for the most part, and if they don't, well, it's just going to show up as a negative in their earnings at some point. But since this is a business where the investment is part of their business structure, I'm including all of those investment activities in their sum of change of working capital as well as their normal capex, depending on whether it's in the operating or the investing line. So the point is, it's just taking me a little bit of a long time. The good news is we're only 35 minutes through a 54-minute call, and I thought honestly we're much closer to the end at this point, so we at least have some time left to go. Before I start the numbers up, I think I'll probably go grab another soda because I need more caffeine, and then I need to stop paying attention to the call as much. But anyway, starting down here at the bottom, the sales capital ratio, you can see the sales capital ratio is very strong, 1.52 over the last 3-year average. If you're looking prior to COVID, their average was more like 1.63, and so they had a little bit of dip in 2020, and it's back up to peak levels right here over the entire 5-year period. You can take that, for example, and it's 1.59. So either way, very strong sales to capital ratio, much higher than the industrial expectations they have over it. You can see on a PE ratio, they're trading cheaper now than they've ever traded in the 5-year period that we're looking at right here, which is crazy to think out. But obviously the argument is maybe some of those earnings evaporate. It's like if the earnings get cut in half, that would make them still only about 11 and something, and which still makes them almost as cheap as they've ever been.
which is one of the crazy things. Like I said, is like I have a really low cost basis on the stock. I'm up extraordinarily high. I've sold a few shares, but I feel like I'm going to find them to be a buy even for myself at this point. It just comes down to the fact that, like I said, I already have too large of a portfolio full of them. But man, I love this company. It's just they're so undervalued and yet growing so strong, and yet they have such strong cash payouts at the same time. It's like they're literally growth, value, and dividend play all in one. It's the perfect trifecta of this stock. Anyway, getting into their assets and the liabilities, obviously their the total balance sheet basically explodes in the next few years once they get the F&G acquisition down. As you can see right here, total assets going from just under 4 billion to over 41 billion in just a 5-year period. So yeah, that's them acquiring the F&G portfolio, which means they get this gigantic asset portfolio, which is why I keep focusing on that investment income. It's like I love the fact they have F&G now, because it's like, yes, they get a huge portion of their revenues from title, but I don't think that's going to stay that way forever. I think that as the investment portfolio grows, that's going to become a larger and larger portion of their income, because it's already the huge lion's share of their assets and their total liabilities. And overall, their total liabilities did not grow nearly as much on the net of it, which is why you can actually see that they did, in fact, grow their shareholders' equity pretty significantly as well. Did it come at other costs as well, but still. And as they said, they have lots of cash on hand. Overall, on the net of it, their debt situation is basically nothing. They have $3.5 billion in debt, but they actually have $4.3 billion in cash. So it's like technically they have debt, but it's really just for the sake of leverage. Returns on invested capital before the most recent year was in these pretty solid teens, which already would have been very satisfactory for returns on invested capital, especially if you're using some debt, which means they were already getting it into the 20s on a pretty regular basis. But now in this most recent year, oh my gosh, 29% returns on invested capital. It's just insane. It's just insane. And then it gets them return on equity of 47.5%. Moving up the line, you can see over the entire period, the 5-year period, they have cash flow of $5.3 billion. Over the period, the amount that they paid out to their shareholders is $2.4 billion. So they're definitely not overpaying their shareholders. In fact, they've only paid out about half the cash flow that they could have. Granted, a decent amount of debt and investment, and also contractor deposits. So that's one of the things. Like in their debt issuance line, I get to include all of the policy premiums paid to them. So that's what I'm saying, is like now they have a float. That gigantic asset portfolio is essentially just a gigantic float pile for them to invest and be able to rake in, a la Geico and Berkshire Hathaway type style situation. So moving up further in the line, you can see corrected net income margin. Prior to COVID, they still had a pretty good margin, much more in line with their industrial expectation. But now you can see ever since F&G, they're in the pretty solid teens, even 15% in this most recent year period. So I've definitely guided downward in my margin expectations and previous valuations of this company to be conservative. But like honestly, it's just leaving money on the table with that assumption. I'm not really sure what I'm going to do exactly today about it, but I don't know. I'll still probably guide downward, but now the current base average is going to have moved up, so the downward position itself will have moved up based off of that alone. And obviously, like I said, huge acquisition. You can see the growth in revenues is just insane. They were pretty stable in a little bit periods. 11% is still pretty strong growth in 2019 alone. But then 2020, which is when they first got some of the F&G revenues, and then more of their F&G revenues in 2021, as well as on the back of huge title premium revenues coming in those years as well. But 45% revenue growth in a stock that's trading at 5.5 times. Like seriously, it's crazy. It's absolutely crazy. Oh, hey, what's up, man? Yeah, this is the one I was saying I was gonna do on Monday when I was talking about it. This is my number one position in this company, and I basically can't buy more because I don't want to have it be even more of a large position of my portfolio, but I feel like I'm going to find it to be a really good buy today, no matter what. Company that has grown 45% revenues in the last year, paid out a 7.5% total common yield if you include share buybacks and dividends, and has more cash than debt, and is trading at 5.5 times. That's this company. It's like, what? I don't know if that doesn't scream the perfect company, then I don't know what else will. Anyway, so I will get back into the numbers here. Actually, hold on just one moment. I know you just joined me. I'll be back in just like 10 seconds. I'm gonna go grab soda.
Okay, so I will play the fourth quarter ball again now. I'll go.
Just wanted to follow up on the margin questions earlier. Just given, what you're seeing now with the mix of sort of strong commercial and purchase and declining refi, is there a way to think about where in that 15 to 20% range you think you could end up this year?
Well, again, Bose, we don't give guidance on margins, but I would just say we're expecting to have a very strong margin in 2022 based on strong commercial performance and modestly improving purchase. I think we always said, you can go back 4 or 5 years when we would talk about that range and what it would take to get to the upper end of the range. We kind of said the same things, a really good, strong purchase market, strong commercial, and refi wouldn't need to be significantly robust to get us up there. So I think we still have that feeling, but
not really like BlackRock.
Number on what 2022.
It's primarily a mortgage reinsurance company.
That's helpful. Thanks. And then actually, just in terms of the rate expectation for this year, to the extent Fed funds is up, 6 or 7 times, can you just discuss what that could do to net?
It's closer to Geico.
Yeah, Bose, this is Tony. I won't speak to the F&G side of it. I think we've spoken to that before, but Chris may chime in.
It's not Fidelity, the investment company. It's just the same name.
Which is really the title portfolio. With rates where they are and a pretty short.
It's an insurance company.
You can see where we.
It's an insurance company that also sells certain investment products, but
investment income for the quarter.
It's not like the brokerage.
It's a bit of a moving target. Hard to know how many increases and when they show up. But assuming 4 rate hikes starting in March, we've kind of mapped it out that it looks like we get to a run rate in the fourth quarter that's maybe $20 million more. So call it $47 million quarterly interest and investment income in Q4 of this year following those rate hikes. And that's not there's no impact there on our fixed maturities or our preferreds. That's really our 1031 exchange business and our cash and short-term investments that would benefit from those rate hikes.
Okay, great. That's really helpful. Thanks.
Our next question comes from the line of Mark Hughes with Truist Securities. You may proceed with your question.
Yeah, thank you. Just out of curiosity, for the January, the daily refi order run rate, do you happen to have that close by? I know it's down, but I'm just curious.
Yeah, sure, Mark. January over January of last year, refi opens were down 57%.
But then, do you have the actual order count by day for January?
Oh, sure. 3,632 orders.
Perfect.
Give or take.
And then, right, yep. And then, Chris, when we think about the PRT business, I think you mentioned a strong pipeline. How would you describe competition in that market, and are you able to get
the gross margin, as I calculate it, is in the 53% range for the current year.
Excuse me, very competitive market, but
usually more in the 40s in the past. It's increased to the high 40s, low 50s
quite competitive, and
since COVID.
Down to Blackstone's origination.
So I could see over the long run it returning back to this like 40 line.
So we've been playing largely in the retiree-only space, and I would say bidding on transactions in the 100 million to $1 billion category. So it's a highly competitive space, but so far we feel quite good about our ability to compete.
Thank you.
Our next question comes from the line of John Campbell with Stephens. You may proceed with your question.
Hey guys, good morning, and Mike, congrats on the new role and a well-deserved promotion.
Oh, thanks a lot, John.
Absolutely. And Mike, you mentioned that purchase orders per day in January, I think you said down 1% versus last year. I mean, that's a couple points better than the industry trends we're seeing. And then obviously we had First American out with, I think they said January orders were down, the purchase orders down 7% year over year. Clearly you guys are holding up much better. I don't know if you can pinpoint how or where that, source of, relative outperformance is, but any thoughts there would be appreciated. And then also, if you guys have it on hand, any kind of update on the month-to-date trends for February?
Sure, John. I'll answer both. It's Mike. In terms of the first question, I don't know that we point to any one area that seems to be more robust than others. I just think we have obviously a very strong footprint and scale, and our continued focus on recruiting, and we've been adding some tuck-in acquisitions. All of that could be helping drive that outperformance to your point. And then in terms of February, we've got really 25% of the month left to report. We've got the last 5 days to report. But I would say that based on if the current trends hold up that we've seen through kind of those first 3 weeks, I think we'll finish February purchase down about 3 to 4%.
Okay, that's helpful. And then, Tony, I don't know if you have this on hand, but you talked to the refi exposure within direct. I'm thinking that's maybe just resi refi, but I don't know if you have a sense for this overall, but what the overall refi exposure would be if you include agency and then commercial direct as well.
Yeah, I don't have that. The number I used when I gave the percentages is you're right. It's residential refi revenue up against total revenue, total direct revenue, which would include, obviously purchase as well as commercial. Mike, do you remember our purchase to refi split on commercial?
Our mix?
Our mix.
Yeah, and it's really been very constant, over the last number of years. But I'm looking for the full year number. In 2021 on the open side, this is for commercial specifically. 69% open orders were resale and 31 were refi. And as we kind of start the year, it's holding at those same levels.
Yeah,
and it's been very constant, John, actually, over the past handful of years, with the real exception only being when the pandemic hit in that second quarter, it skewed to refi from purchase, but kind of reverted back to that high 60+% resale opening side.
And what's interesting is our purchase and refi fee per file on the commercial side is almost the same. It's very consistent. So you don't have this wide disparity like what we have on the residential side. And then,
hey, what's up, GG?
I don't have numbers on agency. That's not something that we collect. My guess would be it's even smaller refi to purchase versus what we would have in our directs.
Okay, and I was just going to ask that just on the follow-up on the agency side. I mean, obviously with the centralized refi business within direct, you're probably going to skew higher on a refi mix there, and so it's going to be lower in agency, and then also the agency refi revenue is probably going to come on at a way lower margin. Is that fair to say?
Well, certainly on a lower margin,
ASML?
because of the splits, the fact that you're getting, you're giving away 20 or 76 cents of every dollar to the agent. But yeah, if you look at the net margin of roughly 10%, which is what we do in our agency business, I don't know if a purchase order versus a refi order gives you a different net margin. We don't have that information.
Yeah, I think it's more an overall revenue number.
Yeah,
I mean a 10%.
Yeah, this is a pretty interesting company.
All-time record.
This is my number one position, actually.
But it's more of a revenue issue versus, I think, a segment issue.
Okay, that's very helpful. Thank you, guys.
Yep.
As I've kind of been talking a little bit at various points already, it's a mortgage refinance company primarily.
First
but
question
they
is
also
title
offer
business.
fixed and indexed
Can you
annuity
comment
products
on any
and have a
changes you
large
saw
investment float
in
portfolio,
competition in
kind of like
4Q
Berkshire
21,
in that way.
and then how you expect the competitive dynamic to play out over the
It's
course
like
of
imagine
2026?
if Berkshire Hathaway
Sure, Ryan, it's Mike.
didn't have
I don't know that
wholly
we
owned
saw
companies as
anything
much as just a
significant in the
regular
fourth
investment
quarter. It's a
portfolio,
very
and
competitive
instead of
business.
like Geico
And
insurance,
we've
they
talked
had
about this before,
real
particularly at the
estate
local
insurance.
level. In local communities, you have thousands
That's
of
kind of what this
competitors.
company
I think
is.
that dynamic's the same. I think you've got the more national underwriters are all competing as they have in the past. So I haven't noticed any significant competitive dynamics. And as we go into next year, I would think more of the same. I think one thing that maybe has heated up is a little bit more acquisition activity with title companies, and that's something we're very interested in doing. We've been doing some of those. We'd like to do more. But that's probably all I would point to.
Okay, got it.
Yeah,
Second question.
but like everything
F&G,
else
if I
in
just
the
look
real
at
estate space,
adjusted
it is
pre-tax
trading
income
super,
divided by
super cheap.
revenue, it looks like the margin's down pretty considerably on a year-over-year
There's
basis.
a
Is
lot
that
of
just a
uncertainty,
function of product mix,
whether or
and
not their
how should we
revenues
think
would
about
fall apart in a
pre-tax
year or two due to
going
real
forward
estate
in that
decline or
business?
something. But
Yeah, at F&G, we
it
really
is super
look
cheap.
at after-tax earnings. I'm not even sure specifically what you're referencing, but I can tell you that there may be some unusual items that are skewing.
Yeah, much appreciated. I myself like long form content for that exact reason. I do other shit while I'm listening.
I can
So
tell you that roughly
nice to know other people appreciate it.
About 100 basis points of our average assets under management, and that's been pretty consistent. Our year-over-year Q4 adjusted net earnings, excluding notables, I think it was like $87 million in the current quarter and $60 million in the prior year quarter, and that's clearly a result of asset growth. And so I'm guessing what we're seeing, and I don't have it specifically in front of me, but I'm guessing what you're seeing in terms of adjusted pre-tax is yeah, I don't know. I mean, I'm looking at it here, 114 million in the current year, 61 million in the prior year. So, yeah.
I would say, Tony, might be a couple things. This is Chris. I think obviously our net product spread has been quite consistent. So, and ROA has actually been trending up. So it could have something to do with how PRT premiums get counted in revenue. I don't know. We'd have to dig into that, but the margins have been quite consistent to rising.
Okay, thanks very much.
As a reminder, if you would like to ask a question, please press
Yeah, thanks.
star 1
Much appreciated.
on your telephone keypad. One moment while we pull for questions.
I definitely think what I'm doing here
Our
is
next question comes on
not done by basically anybody else on YouTube. It's part of the reason I do it. But I also recognize that what I'm doing isn't very interesting for a lot of people. So
one of the first
it's very
relatively
niche.
challenging quarters you've had in a while.
But
have you started taking
but
any
nobody
headcount
else does
reaction
like
to
the work
decline in refis,
live
or is
like this.
that
So
something that's more of a centralized aspect?
that's kind of why I do it.
and doesn't require the same type of adjustment you typically would do with volumes changing.
No, we have actually, Jeff, and certainly in the centralized channel in particular, but we're down about 300 from our peak in October as we sit here in February. So it's been modest, but we've been taking some actions, and I would anticipate some additional actions in this quarter. But it has been more focused on refi channel operations.
Okay. And then when you talked about your priorities for investment, I was hoping you could elaborate on your tech area focus, both with respect to what are you investing in internally? Is it still kind of the digital customer-facing platforms or other areas, including products? And then also in M&A, do you have any growing conviction in areas where you think you want to buy versus build?
Well, I would say on the first point, our investments are more in the continued enhancement and development and adding more feature sets to our existing technologies like SoftPro. And, we've got more that we can do, I think, with the in-here platform as we build more capability into that. And in the real estate technology businesses, it's very similar. As we think about more external, if we find external technologies that we can plug into the things we're doing, we're very interested in that. We do look at that, and that might be an area of future development. And the build versus buy, I guess it just would depend on what you have. I mean, we've got a lot of internal developers in our company, between things like SoftPro and SkySlope and others, and so we've probably skewed a little bit towards that side, Jeff, than maybe the other.
Okay, and then with those various tech investments that's kind of hidden in corporate, what lend themselves most to the title business, or what could turn into more than $1 or $2 million of pre-tax type of income in a given quarter? I think Sync is the only one that's maybe above a couple million pre-tax.
Are you the actual revenue and profitability?
Sig, SkySlope, Pronto. I'm trying to figure if any of those can actually turn into something more meaningful, or if they kind of like are they more almost just like pet project investments, or are those something that can really scale into something that is meaningful for the company over time, or do they provide some sort of other leverage? I'm not quite sure I understand their role in the overall company.
Okay. Well, maybe two things. In terms of sort of gross annual revenues, those businesses combined, I think, are around 120 million. Tony, does that sound about right?
Yeah, maybe even a little stronger than that.
I think that could grow, both through organic growth. We had very strong organic growth this past year, or in 21 actually, over 20, and our EBITDA margins have gotten very strong in those businesses. I think we made over 30 million. I don't have the numbers right in front of me, so I'm trying to. Yeah. So not significant to the whole, of course, Jeff, but not inconsequential either. We still do think, though, that there could be benefits to help drive opportunities into the title operations. Still more work to do on that to see if we can prove that out, but we like the fact that we're selling products and services to our core customer groups well before they have a title order. And we think there's value in building that connectivity, but more work to do, I think, to kind of connect those dots.
So is that maybe more the point, that these other operations provide a customer touch point before the title order, and that's the strategic or overall advantage of these?
I think that would be the more strategic side of it, but we're an operating company, and we've got a business that we feel pretty good about with strong revenue and strong profitability, and we think we might be able to add to that either through acquisitions of other types of companies. But you're right, more on the strategic side would be the latter point.
Okay, great. Thank you.
Thanks.
And this will conclude our question and answer session. I will now turn the conference back over to CEO Mike Nolan for closing remarks.
Thank you. We delivered another outstanding quarter with year-over-year increases in revenue, adjusted net earnings, and assets under management. FNF has a strong track record of market share growth, best-in-class margins, technology innovation, and shareholder value creation. It is very exciting to see the opportunity ahead for our market-leading businesses, which are strategically positioned for long-term growth in attractive sectors and with sustainable competitive advantages. Thanks for your time this morning. We appreciate your interest in FNF and look forward to updating you on our first quarter earnings call.
Thank you, and the conference call has concluded. Thank you for attending today's presentation. You may now disconnect your lines at this time. Thank you for your participation. Enjoy the rest of your day.
All right, well, the call ended. Still have about 2 years left to go. I definitely knew that they were going to beat me on that one. I as I've said a few times, the cash flow statements and the balance sheets for this one are just extra complicated. Though the juice is worth the squeeze if you're willing to read between the numbers a little bit. But as I said, the balance sheet is particularly obnoxious because it doesn't categorize things into current and non-current assets and liabilities. So you kind of have to make some decisions about what falls into either category, which takes a little bit of time for me to sort of do. And then the cash flow statement's also complicated for somewhat similar reasons because of the fact that they manage a very large investment portfolio on float. That means that all of the investment categories that are just like security trading and stuff, that for most companies, I basically just ignore that stuff on their cash flow statement. I'm just assume that that stuff just kind of bounces out and it's basically just them trading their cash assets in and out of things as liquidity needs. That's what most companies do. So you can basically just ignore that stuff. But for this company, it's part of the bread and butter. So we actually include all that stuff in their cash flow statement, which means it's like double the triple as many line items in the cash flow statement essentially. So it's just an extra complicated valuation to do, but worth it, because when you read between the lines, you get to see that they're taking in all these insurance premiums, and then they end up with this gigantic investment portfolio as a result of it, and that resembles very similar to me what Geico looks like on the inside of Berkshire Hathaway. This, like I said, this is a little bit more of a real estate focused version of that, I guess I would say. Their primary business is mortgage refinance and title insurance associated with that. So they were associated with the real estate market. They do have a lot of exposure to revenues associated with that without actually having exposure to the the property values themselves. But they do have insurance claims against people essentially abandoning their homes. So they do have a decent amount of exposure to the overall cash flow of the real estate market regardless. And they get to take all those premiums and then they get to invest them, and then depending on how many mortgages get abandoned, they get to have to pay out a certain amount of them, which they make reserves for claim loss to cushion themselves against these losses, and then the rest of their money they get to keep as investment income. And then beyond that, they also have the F&G acquisition that they made, the S&G acquisition that they made a year and a half ago, which is a large fixed and indexed annuities products company, which basically splits off their business into doing that, which in a large sense gets to do a very similar type of float built structure, which basically just makes the overall investment portfolio that they're allowed to manage even larger. So now they've diversified a little bit away from real estate, though it is still mostly the lion's share of their business for the time being. While also making the vast majority of their balance sheet focused on the smallest segment of their business, which is one thing that I like about the business. It may seem strange to say that, but it's like they only receive like 15% of their income currently from investment income, and yet like over 75% of their balance sheet is devoted to the investment portfolio. What that means is that there's a lot of potential there in my mind for the future, as well as a decent amount of cushion against potential declines in the real estate market. We'll get into how, like I said, I plan to project all of those revenues once I'm done with all these numbers. We do have 2 more years to go. But yeah, because of that large acquisition though, and the fact that real estate's been on fire for the last 2 years, their revenues have just absolutely gone through the roof. And then their earnings have gone through the roof as well, but they're still trading extraordinarily cheap. So there's not a lot of companies out there that grew 45% in the last year in revenue terms and are trading for 5.5 times their earnings and pay out 7.5% of their market cap in dividends and buybacks in 1 year. Like, it's a growth, value, and income stock all in one. Pretty much the perfect trifecta. Which is why I have so much exposure to it. Well, obviously multiples can be pretty all over the place in all industries, but in general, financials do trade cheap. I would
I would typically say like financials, like where you might say the rest of the market might be at 20, financials might be at 10. That is pretty typical. So if you see the rest of the market going to 15, then seeing financials go to 8 or 7 is also not necessarily unreasonable. But like I said, it's kind of half finance, half real estate. It's kind of caught between the two in a sense. And real estate also typically trades cheaper than market, but I would say maybe not as cheap as finance typically does. So 5.5 times your earnings is still pretty cheap, especially since honestly they're still expected to grow revenues this year, for this year at least. Obviously beyond that, maybe that's where more of the uncertainty starts to push in. But I don't know. We'll get into definitely all those things, but multiples can be all over the place. I definitely don't buy things strictly for the multiple sense. I've definitely found stocks on the channel where we've seen them trading at like 5 or 6 times earnings, and then I still said they were overvalued. That still happens. So it's like that doesn't necessarily mean anything per se. There can be a lot of other factors go into it, but I mean, like I said, I've owned this company for a while, so I've already looked at it pretty closely. I would be super shocked if I found out that it was overvalued today. By the way I do it, just because my old valuation said it was so much undervalued still. Like it would be pretty surprising to me, but we'll see. But it is trading cheap because people are uncertain about the real estate market. It's like if real estate takes a huge slowdown and that slows down all of the refinancing that's done in the market, well then the stock's revenues will decline as a result, or at least that's the perception. And in my previous valuations, I generally have always guided pretty conservatively on those assumptions. I mean, I generally have assumed that they were going to grow their revenues at least modestly, but I usually guided pretty downward in margins. So I don't know. The fact that their margins keep going up and up and up is just another factor that leaves some of that uncertainty there. People don't know if the margins are going to return to where they used to be, or if this is all these new gains and margins are actually a result of the changes in their business. Like I said, they have done an acquisition, so it's hard to be sure if the new margins are going to be the post-acquisition steady state, or if it's a temporary boost that also has to do with the booming market. So the high margins is another part of the uncertainty. People are uncertain if that's going to stay that way or not, and typically are probably guiding downward, like myself. But the point is a stock trading cheap is just makes the valuation even better, in my opinion, because it means that even if people are only looking at just the multiple, then that means they're not going to look at it as some obvious sell. They might see exactly what I said: 40% revenue growth, 13% net margin, 7.5% common yield, and 5.5 times earnings. And it's like, wow, all that together, that sounds amazing. It's only when you say, oh well, they do mortgage reinsurance, do you think the housing market's gonna keep booming? That's the part where everybody's like, now all those things come into question. Are their revenues gonna drop 20%? Are their margins gonna drop 3%? Maybe not. Even if the market took a decline, how fast would their revenues come down? Probably not super hard, but over time, I guess we'll see. Like I said, I have a revenue model that I put together to kind of show my thoughts on this. Let's see. Equity offering. cash, securities available for sale, receivables, plus income tax receivables, other current prepaid expenses, as well as the short-term investments, and then PP&E, because we're including investments in all of our CapEx, we're including all of their investments in PP&E, as well as the title plants. There, nope. Liabilities. Okay. Is that the only other liability on there? Was equity. All right, one more year to go. And then we can get into the good stuff. Yeah, you can see like in some of these past years, they have auto parts revenues, restaurant revenues. You can tell they were operating a little bit closer to something akin to Berkshire in the past. They didn't have actually as large of an investment portfolio, ironically enough. They did have a large insurance operation still, but they didn't actually have like the float system in place. But they did actually have a bunch of other like idiosyncratic industry holdings like auto parts and restaurants and stuff. So it's kind of funny seeing the way that they've evolved over the 10-year period. But I definitely like their current model much better. Like I said, the gigantic amount of float. Okay. Now for the final cash flow statement. Oops, forgot that. Capital expenditures. See like all this proceeds from sale of investment securities, proceeds from call and maturities of investments, proceeds from sale of other assets, then PP&E, purchases of investment securities, and see how it's like that's $1.1 billion versus the 79 million they spent on property, plant, and equipment. So it's like obviously the vast majority of their investing activities is related to investment securities. So we're essentially just going to include that all in as PP&E because the PP&E is basically nothing. So it's like it's just some offices, you know. I mean, they don't really need anything for that. Which is like you know, we do similar things with like the tech companies. You know, that's why I do the R&D capitalization concept. It's like because property, plant, and equipment's not really that important for a software company. I mean, yeah, they have a decent amount of it often, but that's not not really the important part. The important part's the amount of money you've put into research. So it's like in this company here, it's the investments. It's literally the securities themselves. So where in a lot of companies you would ignore this stuff because it's just kind of financing stuff, that is literally the bread and butter of this company. But that makes my job right here a pain in the ass. Look at all these things one by one very carefully. To get a real idea of just how much they reinvest, which is really the whole point of doing the cash flow statement in the first place. Technically, you could just do the income statement and make projections off of that. You know, technically, that's really all you need to make a future projection of earnings, is to have the earnings statement. The reason why I do the cash flow statement and the balance sheet is because those two provide me other information that gives me ideas of like exactly how much they've been reinvesting in all various categories. So it's like, this is really just the part where I'm learning how their business works. Even though these bottom two sections, almost none of it actually goes into the valuation. It's mostly just me working through their last 10 years of numbers. Anyway, so there's the final cash flow statement. Now for the final balance sheet. Cash and equivalents. Marketable securities, which we're only listing the ones they have available for sale. So the rest of them we list in the property, plant, and equipment. Receivables. Pretty small amounts of receivables for them. And then the only other things we count as current are the prepaid expenses and the short-term investment. Like I said, all the property, plant, equipment, plus the title plants, because that's also the mainstay of their business, plus all the investments is the PPE. Then goodwill and intangible assets. And there's nothing left over for the other assets line. Now liabilities, accounts payable, we include income taxes in that. Other current, we include the secured trust deposits, plus the reserve for title claim losses. That's the money that they have available for covering losses on the reinsurance. Long-term liabilities, we count the notes payable, and that's the only thing they really have listed for that. Then deferred tax liabilities. And there's nothing else after that, too, I think. All right, so now the equity statement, which this part's a lot more straightforward. All right, we did it. So now we can get into the fun stuff. As I had shown in the 5-year trend, the sales to capital ratio is pretty strong. And you can see over their entire long-term history, it's been pretty strong. Over the long run, we have 1.41 as sort of the average. So we can perhaps use this as a place to guide for it to go over our long-term trend. Though I think using perhaps the 3-year average makes more sense for a base year, because obviously if 1.82 is where it was in the most recent year, even if it had declined the next year, it can only go down so much. So I'm going to use that probably as the base, but either way, very, very strong sales to capital ratio. As you can see over the period, this is where they've generally traded. So if like you ask me, it's like, oh, well, is it cheap for the industry? It's like, even for industries, it can be very difficult to kind of nail down a specific PE. Honestly, it makes more sense to compare a company to itself, because that's like that's about the only way you can get a truly accurate picture of a company that's truly comparable, right? It's like, well, how about the company itself? So look at it over the long run. Obviously, business models change, and so that's the part where things get a little bit more complicated. You could argue that 2020 onward is one business model, and 2019 through 2016 is another business model, and then you could argue that 2015 through 2012 is another business model, as they've kind of shifted the business model over this entire time frame. And you can see that the PE itself has kind of shifted over this time frame too, though there are outliers in the space. But in general, right now it's trading cheaper than it basically ever has, even though it's trading at way higher revenues and way better margins. But again, as I said, it could be the uncertainty associated with those things that makes people think that. As I said, looking at the balance sheet, so obviously they had shifts in their business model beyond just the one that they had in the middle towards the end, as I pointed out in the 5-year trend. But even so, the total assets is 60 billion versus the 10 billion it was 2 years prior to that, and the 10 billion or the 9.9 billion it was 10 years prior to that. So yeah, they've basically massively increased their balance sheet, and that's basically just a gigantic asset portfolio for them, as we've basically talked about. So compared to the fact that they have this gigantic asset pile, and most of that goes into investment, even though the vast majority of their revenues, which are 15.6 billion, come from title insurance and reinsurance products. So I see the investment portfolio as an opportunity for revenues to grow outside of the real estate market. Obviously, that's still tied to other investments, but we'll get into why I'm not necessarily super concerned about it, because it's not like it's a huge stock portfolio. It's actually more bonds than anything else. So we'll get into that. Coming back down to the cash flow statement, over the 10-year period, they have paid out $7.3 billion to their shareholders. The total, or no, my bad, that's how much they could have paid out, was $7.3 billion to shareholders, while they've actually paid out $3.1 billion. So they haven't come in even close to overpaying the shareholders. They haven't even paid them half as much as they theoretically could have. Even this is on the back of dividend that's been growing at 16-17% compounded for the last 5 years, and pretty significant growth in share buybacks in the last couple of years, though. They've also had years further in the past where they were diluting shareholders as well. So that's worth noting, that kind of detracts from the overall 10-year payout on the net of it. So looking at the corrected net margin, as I was saying, you can see in the most recent year, it's 15.5% or so. 3-year average about 13 to 14%. Over an entire 9-year period. So looking over the full long run of including all of the forms of their business models in net, we get to more like 9 to 10%. So you can see why, even though it's trading at a 15% net margin right now, a lot of people can perhaps be giving it a lower multiple on the assumption that it comes back down to these lower margins in the future. But either way, I've done those assumptions in my previous valuations, and it still has generally come out to look like a great bargain anyway. So that doesn't necessarily mean much. And as I've said before, they kind of had a slightly different business model at various points in this 10-year period. And the part that's way back here in the further past is the part when they had the restaurants and the auto parts associated with the business as well. So that means that they had a very different cost structure that gives them lower margins, because that's like retail and auto part type business, and both of those have lower margins. So it actually makes sense for them to have lower margins in this back half, or this previous half of the history. And so for that reason, on the base, I'm actually going to use the 5-year, which is a little bit higher, but perhaps not as high as the 13% that we had there. So we can still see some potential for a decline. We're actually, I'm thinking we're probably going to guide more towards the number. We'll probably use the 3-year average as the actual base so that it kind of trends towards it, but we'll probably guide towards something like an 11 or 12% in our future projections. So looking at the revenues, even prior to 2019, you can see that they were at least growing, though it has a pretty lower amount of growth, as I kind of had said before, that they didn't necessarily. In my previous valuations, I generally guided them to have revenue growth, but not usually very high revenue growth. So, for example, last year in my valuation for the company, I had guided them, I think, to have like an expected around 3 or 4% revenue growth CAGR over the 5-year period. I knew that they were probably gonna have much higher growth in this current year, but I was essentially assuming the potentiality for them to have revenue decline further after that. Lo and behold, they have 45% revenue growth this year, partially because a lot of that came from the acquisition, but also partially because of the huge boom in real estate. So it's like, yeah, 45% revenues. Even if they took a 20% haircut to their revenues, they would still be above where they were last year and above any other point in the 10-year past history. So I don't know. Definitely not super worried about a decline in the stock, though that is a higher concern for people who are more likely to be purchasing it in the near future. I myself have a large amount of exposure to it already, and even if it's severely undervalued, I won't be buying more because it's already my largest position. Anyway, as I typically say, don't get too excited about this number right here, although who knows, that could look at something like that in the end. We still have to do all of our usual projections and stuff. I will show my revenue projection thing I got going on over here. So this is the revenue in the most recent year, $15.6 billion. And this is the investment portfolio that they manage, $38.9 billion. Now they give a bunch of details in their 10K about all the specifics in their investment portfolio, and I have that all included in here. And so I've done a bunch of numbers in my spreadsheet on it. They include the credit rating for the different securities they have and how much are in each credit rating, so you can kind of get an idea of what type of credit risk they have to their portfolio. They have a whole bunch of information that you can use. So rest assured, I've looked at it. You know, I'm not just making some projections off of nothing. This is where these numbers come from. They have this $38.9 billion. They have $1.9 billion in investment interest income. That gross yields them about 5% yield over the course of their entire portfolio. Now that's the past, that's the most recent year, but we wanted to at least have that guideline to look at to get an idea of just kind of what type of money they can earn on this. They have $1.5 billion of United States Treasury securities, about 4% of their portfolio. They have $26 billion in investment grade bonds, about 67% of the portfolio. They have $2.3 billion in below investment grade bonds, about 6% of the portfolio. And then about $9 billion in equity, private equity, real assets, and other stuff like that. So it comes to about 23% of the portfolio. That makes overall, if I'm using expected returns, this is the part where things come up. I use the 10-year Treasury for my expected return for the United States Treasuries. Investment grade yield, I have the weighted index effective yield of investment grade U.S. securities, which is currently, according to the Fed website, 3.17%. So I'm using that. For below investment grade, we have 5.46%, which I have the same data from the Federal Reserve for that, and I get 5.46%. For the equity in other assets, we're using 5.07. That is the expected return that I have on the S&P 500 currently, based off of 10-year Treasury plus the equity market risk premium I'm using currently. Just those two added together. So I'm going to use that for the expected return for equity for them. All those weighted multiplied by the weights and weighted together, the weighted return I get for their portfolio for the next 5 years is 4.16%. So that's kind of our baseline, 4.16% return on the portfolio. That's not the yield that they'll receive. That's just how much the portfolio I expect to grow. Now, we can assume that in a best case scenario, maybe it does 50% better than my expectations. And in the worst case scenario, we assume it does half as much, except it's actually going to be a negative of half as much. So we're actually going to 0 and then subtracting from half as much. It's a kind of interesting point. Either way, that gets us a range of anywhere from 6 to 0.24% per year return for their portfolio to negative 2% in the worst case scenario. You might think that that's not a very wide range of return, but again, this is 67% bonds, investment grade bonds. It's over 70%, over 75% bonds in general. It's mostly a bond portfolio. So either way, I'm expecting anywhere between 6.24% to negative 0.28% for the portfolio return, and that means that the portfolio in 2027 will equal $52.7 billion or $35 billion in the worst case. Now, the yield of 5.03%, which is the yield that they have over here on their investment income, I'm going to assume that in the best case and worst case scenario, similarly with the other case, it's either 50% better or 50% worse. I'm not going to do the negative effect on that one in this case because the yield's not likely to go negative. So either way, that gets me perhaps the assumption in the best case scenario they actually get to earn 7.5% off of this portfolio. In the worst case scenario, maybe they only get to earn about 2.5% off that portfolio. Either way, those numbers gets us 2027 best case scenario investment income of $3.9 billion and worst case investment income of $883 million, which isn't a gigantic increase in investment income relative to the $1.9 billion they have in the most recent year. Even so, I mean, that's more than doubling in the best case scenario, and then it's getting cut in half sort of in the worst case scenario. And again, that's just one part of their business, not even the biggest part of their business, but it is the biggest part of their balance sheet. So that's the reason why I focus on it so heavily, is because it's a huge part of the value of their assets. Now they also have the F&G part of their business, which is fixed and indexed annuities. That is $1.95 billion in the most recent year. I just realized I actually totally forgot an important sheet I needed to bring up. Mikey, stop. My inflation sheet up, I just realized I had a projection on here I wanted to show. Okay, so for F&G, they're a fixed indexed annuity company, which means that they're going to sell annuity products partially based off of indexes that move up and down. Some of them are indexed to inflation, other ones are indexed to certain assets and other products, but either way, I'm projecting my revenues based off of essentially my assumptions about growth of inflation. Now this is where things get a little bit complicated, because that means I had to kind of come up with my own assumptions about what I think inflation is going to do. Now this is the part where you could disagree pretty heavily on, but this is what I'm projecting for inflation currently. It's total ballpark numbers. Don't expect these to be super accurate. I'm making a wider range on the revenue projections either way, but if inflation is currently at the end of Q4 was at 6.83%, and it's currently at 7.75% or 7.5%. By the end of Q1, I could see it maybe ticking higher in the next month that they report, so possibly maybe about 7.75%. Unemployment was at the end of Q4 4.2%, and at the end of Q1 I could see it coming down to 4%. Federal funds rate, they're about to start moving up, and then GDP, I expected, in real GDP growth, I expect to start trailing down. So I kind of just made this model to come up with an idea of what I think inflation is going to be, but it's totally out of my head. Just so everyone's clear, this isn't some mathematical thing I came up with to get an idea of what inflation is going to be. It's more of me thinking about how fast do I think the rate could move down in relation to how fast I think they can move interest rates up, and how much I think in unemployment and GDP could change over time. Either way, I just came up with this inflation number here, and it either way, the numbers come out to me expecting a 10-year inflation rate of 3.74% per year. That's including this year, just so it's understood. It has to be that part's important because we're currently at 7.5% growth, and it's not including that 7.5, but it is including whatever gets reported in the next month, which isn't going to be 7.5, but maybe it's slightly down from 7.5 or slightly up from 7.5. But the point is, it's not going to drop immediately down to 2% next month and then stay there. So even if inflation comes down to 2% by the end of this year, then the 10-year rate is probably going to be like 2.5%, even if, as long as it's 2% forever thereafter that. So just so that's understood, like how the compounding works. So the 10-year inflation rate that I'm projecting is 3.74%. But that's, like I said, kind of a pretty made up number. I wouldn't go make any claims that like that's really going to happen. I expect to be pretty significantly wrong on that. But either way, as I typically do, I take that kind of baseline assumption and multiply it up by 50%, and worst case scenario down by 50%, and that gives me a best case scenario of 5.61%, a worst case scenario of 1.87%, and then doing that by 5 for over the revenues for till 2027. That gets me $1.8 billion in 2027 and $1.5 billion in 2027 in the worst case scenario. Now for title insurance, they have $11.7 billion in revenue in title insurance in the most recent year, which for this, I went to the all transaction housing price index for the United States and looked at the percent change compounded on annual sum. And you can see that this is the chart that we end up with. Now, I'm using, this is kind of an arbitrary number, but I'm looking at the biggest decline we have over this entire history here, which is from 2009. We had a 5.55% decline in housing prices that year. And in the best case year that we had 14.04. So those are the numbers I'm using. It was supposed to be 5.05, 14.04. I think I mixed those numbers up. But either way, so that's the best and worst case declines and rises in housing prices over the period, and I'm using that as my basis for the expectation of revenue growth in title, and worst case title declines. Now, obviously, they're not really going to be that long over a 5-year period, so I think that's a pretty wide range of best and worst case scenario. Now, they also do, because of the fact that they are expecting to have losses on their insurance pretty regularly, they also have a provision for loan loss, and they regularly take out 4.5% of the total insurance claims as that loan loss percentage. So we're going to take we're going to take that 14% best case scenario and -5% worst case scenario, and we're going to subtract out 4.5% on both ends of it. So they end up with 9.5% in the best case scenario and -0.5% in the worst case scenario. Basically, the logic of this is that on the best case scenario, if housing prices are rising 14% per year, they're still going to have to pay that 4.5% claim, and that's going to chip off their growth to this number. And the worst case scenario, if the housing prices are going down 5%, they're going to be able to use that 4.5% claim to soften their losses. So that's how we're going to get this range right here. And based off these numbers for 5 years, we end up with 2027 revenues for title insurance of 18.5 billion in the best case and 11.4 billion in the worst case. So we add up our three segments of revenues, and I end up with 24.3 billion in the best case and 13.8 billion in the worst case, which gets us a revenue CAGR of 9.29% and -2.37. So we'll use 9.5 and 2.5. So -2.5 and 9.5 will be our revenue range. I will use just the average between the two for our analyst number. 3.5. Come on. All right, so we'll do 3.5 for that number there. This is going to be our revenue range. We'll come down to the debt to equity ratio. You can see it's at 22 to 23%. Move your tail. Jesus Christ. So let's assume that they have a pretty decent decline in the market cap, maybe by about a third, possibly down to about 10 billion overall market cap. And then we also assume that they take on a pretty significant amount of debt. They could perhaps double it. That would get them to about $7 billion in debt, which would get them to about a 70% debt to equity ratio. So worst case scenario, 70% debt to equity ratio is about what we could see. And then in the best case scenario, they're already at 22% and they actually already have net cash. So it's actually pretty reasonable to assume that they could pay down all of their debt in certain circumstances. So 0%, we'll go ahead and leave that in. That gives us an expectation of 33.5% before adjusting for probabilities. We'll probably bring this down to about 15% or maybe even 10%. They did say that they were going to pay off the debt in the next year, but they also talked about potentialities of extending it depending on opportunistic circumstances. Maybe bring this down to 60%. That brings the debt to equity expectation to 27%. I would prefer that it was like around 20, maybe 50%. And you might be wondering, it's like, why is lowering the debt to equity ratio bringing the value down like that? Well, partially because in the worst case scenario, you don't necessarily want the equity to be funding the operation. So that sort of creates a balanced scenario where in that situation, they actually want to have more debt, but then it also creates higher default risk for them. All right, so now our expected level is at 22% before adjusting for probabilities. That's about sort of where we wanted it to be. Going up to the sales to capital ratio, our expected level is currently at 1. As I had said before, we're going to try to make the expected level kind of close to the 5-year average, which we think is relatively, or actually we're going to use like the 9-year average, I think, which is relatively in line with a longer term expectation for capital efficiency. 1.4 is what we get for that. Maybe you kind of put in 2.5 on the high end to kind of get us to our midpoint. 1.5 is probably way too low, which means we're going to probably lower this as well. Yeah, so 1.4 is kind of in the midpoint there. We can bring this to 1.5 so that it kind of trails upward a little bit. Expected value is 1.39. Okay. Now we go up to the profit margins. This is the part where I was saying we're going to guide towards the 5-year average. That's right, which is close to about 12%, 11 to 12%. It's currently sitting at 10. 5-year lower point I think is pretty decent, but we will probably extend the upper bound to maybe like 16 or 17, and then put this at maybe about 12. Maybe push it a little bit higher, but I'm also going to shift the probabilities, so I don't necessarily need to push it higher than that. Let's see, the cost of debt is fine, the tax rate is fine. Let's see, 3 years, the returns on invested capital all combined comes out to about 22%. 5-year period, it's closer to 20%, which is a bit in line with what we're projecting, so I think that makes sense. The most recent year of close to 30% is definitely a little bit of an outlier on that, so the 5-year trend, I think that makes sense of about where it might come down to over the long run. This seems to be in line with what we're currently projecting. Let's see. Anything else other than probabilities and default risk? All right, so let's shift the probabilities around a little bit. Now, I am going to include a decent amount of potential for decline. Now, you don't see me do this very often. The worst case scenario, I usually don't change it past the 5%. And the best case scenario, I don't usually change past 5% either. It's like usually I leave those tail ends just at 5%. So if you want some proof that I do take the potentiality for housing decline seriously, there you go. I put 10% into the worst case scenario potentiality. And again, this is a 10% assumption that they have a 2.5% decline over the 5-year period, but that may not be an even decline. It might be even this year, and then a decline of 15%, and then they grow out of that from there. So it's like, that's one of those things to keep in mind. But that also runs into the assumption that in that particular case, it drops down to a 5% margin, which is basically as low as they've ever had, as well as it also drops their sales to capital ratio down pretty dramatically and brings their debt to equity ratio up, as in all of our typical worst case scenarios. So I think everything else I'm pretty satisfied with, other than the default risks. Well, maybe do I want to shift the probabilities a little bit more? Let's see. Okay. Yep, okay, so I guess we'll just adjust it for default risk. And that will be it. You look at the perpetual debt levels versus the overall cash levels.
Yes, we'll go ahead and say that it's pretty low default risk overall. Scrape again for some reason. I don't know why. Yeah, so as you can see, there's a decent expectation that the sales is going to come back. The analysts are projecting a 15-16% decline in sales growth this year, even though the current expectations from the guidance that the company has given, the executives have given, basically gives no real indication of that whatsoever. So I don't know. That's just my kind of perspective on it, but so that's going to do it for FNF. Ticker FNF, Fidelity National Financial. The U.S. Treasury is selling for 1.967%. Mature market equity risk premium I get is 5.1%. You come up to a discount rate for FNF after adjusting for company-specific idiosyncratic risk of 8.79%. They currently have a dividend yield of 3.4%. They've had sales growth for the last 5 years of $16.6 billion, or 60.6% per year, which is pretty crazy. Like I said, a lot of that has come in the last 2 years. Sales capital ratio in the most 3 years on average has been 1.52, relative to industrial expectations of 1.02. Their returns on invested capital are 19.93% in the last 3 years on average. They have a debt to equity ratio of 22.56%, which is pretty decent. And on top of that, they end up with default risk of only about 1% in the most recent year. Profit margins are 13.75% for the last 3 years on average, relative to the industrial expectations of 10.46%. So they have pretty high sales to capital ratio, returns on invested capital, and profit margins relative to their industrial expectations. Their profit in the most recent year is $2.4 billion, and they're currently selling for $47 per share. Probability distribution that we use is pretty heavily tilted towards the less optimistic potentialities, showing that we are weighing in those outcomes pretty significantly, even though the value looks pretty great on those bases as well. Either way, we end up with revenue projections of anywhere from $13.7 billion to $24.6 billion in the best case scenario. On an expected basis, we see about $18.3 billion, which gets us about a 3% sales growth per year for the next 5 years. Sales capital ratio, we're projecting it to come down to about 1.35, which would get it a little bit closer to its industrial expectations, but also much closer to its more long run averages that it's had. Returns on invested capital, we're seeing that coming down to a projected around 17 to 18%, which would still be pretty outstanding, but lower than the current levels. We do see them perhaps taking on a bit more debt during the period, or perhaps paying down some debt, but also having a market cap decline. Either way, the debt to equity ratio coming up a little bit. Default risk, we see pretty negligible, almost none to really speak of for the whole period. And profit margins, we have a distribution of anywhere from 5% to 16%, which gets us an expected value of about 10.31%, which also gets us a distribution of profit from anywhere from just under 700 million to possibly just under $4 billion in the best case scenario. On an expected basis, we see just under 2 billion. We have a present value expected price of $77.16.
which is 64% higher than the current share price. We have 5-year forward value targets, unadjusted for the dividends that they would pay out during the period, of a worst case scenario to $45.66 to a best case scenario of $260.50. On an expected basis, we see $117.55, which compared to the current share price, it's an implied return of 20% per year or so, which is pretty outstanding. Value score 1.47, really high sales capital ratio, really good returns on invested capital, really good profit margins, really good projected on all three of those, really good absolute and relative valuations and returns. Yeah, no surprise to see that high of a value score. Like I said, it's my number one position for a reason. Even if you make pretty significant assumptions of other potential worst case things, like maybe like this, for example, drop the revenue assumption from 3% to a decline of 0.5% per year on expected basis, and we still end up with only a drop of about, what, 20% was that? It only dropped to about 20% if you did that. So it's like, you can see it's just an incredibly cheap stock, pretty much no matter how you spell it. Even if my projections that the housing market's going to be much better than a lot of people expect it to be for the next couple of years, that's where my assumptions come from. Is if you look at this and you're like, well, there's no way they're going to get 3% sales growth after they just did all the sales growth they did. Maybe that's what where the fundamental change in the multiple comes from. Well, it's like, well, fine, let's put some pretty dramatic numbers in there. Negative 20%, that gets you to a negative 5% sales growth each year for the next 5 years, and it's still worth $69. So you can see that this stock is just incredibly cheap, in my opinion. I may be biased. I do have a holding in it already, but that is my perspective. So that's going to do it for Fidelity. As I already talked about at the start of the stream, we already know what we're going to do for our next stream, but there was one other thing I kind of wanted to point out before going today, which was one valuation that we did last fall at one point was Ferrexpo, ticker FEEXF, which I wanted to bring attention to just because of the crazy stuff that's happening right now. This company is a Swiss company with mining assets in the Ukraine. I don't know if anybody was around and remembered me doing this valuation, but I was doing several valuations in foreign companies at the time, and I ended up doing this Ukrainian mining company essentially, and I've been kind of keeping an eye on it ever since the conflict began with Russia, which has been pretty interesting. I just kind of wanted to bring that up in case people didn't know that I had done a valuation like this, but obviously it has been crushed since the invasion began. It does require paying foreign fees in order to have a position in it, and it would be incredibly high risk of a position, but it's almost worth taking a look at. On this valuation, I basically assumed that their margins get absolutely crashed over time, that their sales to capital ratio absolutely gets crashed over time, that their revenues absolutely get crashed over time. And either way, I still ended up with a valuation that is way higher than its current share price. And then it's also just increased as a valuation since then. But obviously, I'm definitely not recommending this to anybody, considering it, like I said, it is a company that operates in the Ukraine. Who knows if that mine will exist at the end of the year? It could have already been. It's a Swiss company that trades in the UK. Yeah. Kind of a weird structure. It's like Swiss corporation, UK listing, Ukrainian assets. Yeah, it's a kind of a weird company, but. Point is, if anybody has a large portfolio and doesn't mind putting fees into foreign fees and also doesn't mind taking on an insane amount of risk, this is an interesting opportunity that's on the table, and I wanted to bring it to my viewers' attention. I'm not going to do a position like this because, like I said, the fees. I can only make a position like this profitable for me, given the fees that I would have to pay, by making it like at least 3 to 5% of my portfolio. And I definitely do not want a company like this to be 3 to 5% of my portfolio. It's like I would maybe put 1% of my money in it if I was feeling pretty lucky, I guess, because like I said, I don't know. If you assume that Russia takes the Ukraine, well, then who knows what happens to all those assets? They may all just be completely shot to hell. It may just be completely taken over. And then even if they didn't take that particular stretch of land, even if they didn't take that particular stretch of land, who knows? Maybe the assets could be damaged. I don't know, and who knows when they can operate again. But I did think that was interesting. Of course, it doesn't want to. This is where this is around the area where the mine assets are, is this place, worth noting. And here is the Ukraine. There's Kyiv. There's Kharkiv. I know that the Russian troops have already taken Kharkiv. That was reported like a few days ago. I know they're trying to surround Kyiv. I know they already had like this land. This is like the place around the place where that nuclear power plant that just got fired on yesterday was at. So you can see they're kind of already surrounded. Not really very great of an opportunity. And also they're kind of on this side of the water. So I don't know where the mine actually is. It could be on either side of it. Yeah, they're like really in the middle of it. If you look on their website, they were giving updates up until a few days ago. They were working straight through it. Like they stopped operations as soon as the invasion. Oh man, it's no longer going to let me get to that part of the website. See, now I can't even get on their website. I don't know. It looks like something may have happened literally in the last day. I don't know. Whatever. I just wanted to bring that up because I was just like, wow, that's crazy. Who would have thought that that Ukrainian company that you valued would be literally in the middle of a war like 6 months later after valuing it? But either way, interesting things happen. Just thought I'd bring that up. Who knows if the Russians pull back and they only take like those territories that they claimed they wanted from in the first place or whatever, which wouldn't include that area, and the mine hasn't been shot to hell, then anybody who piles into this could be making some crazy returns in the near future or something. Because I mean, before the invasion, I'm pretty sure they were like 350 or something, and I was still projecting them, you know, Mikey, stop trying to go across, Jesus Christ. But yeah, so just an interesting thing I noticed on my watch list, because they are on my watch list here and they shot to the top of the list, so that's how I kind of knew. See, and that's kind of the point of having this, is that it made them automatically shoot to the top, and I was like, oh hey, it's that one company that may or may not exist a year from now, but whatever. Definitely not recommending it anyway, but I thought I would bring it up. So that's going to do it for us today. As I said earlier a couple times, I'm planning to do Corsair on Monday and Nerdy tomorrow. I already have basically all the prep work for Nerdy good to go, and I'm working on the preparations for Corsair. Nerdy is a holding I had in the past, and it's not one I currently hold, but I do have a friend that has a lot of exposure to it, so I kind of analyze it and keep a close eye on it because of the fact that he used to work for that company and has a bunch of options related to it. And then Corsair is one of our larger holdings. That's our second largest holding currently, so we will definitely be covering that with Turtle Beach, probably following that up soon after that. So